The most dangerous words in finance are often the ones a central banker refuses to say. Kevin Warsh did not raise interest rates at his first press conference as Federal Reserve Chairman, but within hours, the bond market behaved as if he had. Two-year Treasury yields, one of the market's most sensitive gauges of Federal Reserve policy expectations, jumped 13 basis points to roughly 4.18%, the biggest move in more than a year. Bond traders received Warsh's message loud and clear. This Federal Reserve would not tolerate high inflation simply because markets wanted easier money. This is the global ledger, where we follow the hidden machinery of money, power, markets, and the institutions that shape the global economy. For nearly 2 decades, investors had been trained to believe that when markets trembled, the Federal Reserve would eventually come to the rescue. Kevin Warsh had seen the system from the inside. He served as a Fed governor from 2006 to 2011, through the housing market collapse and the deep recession that followed. After years of extraordinary policy support, investors learned a dangerous lesson. Cheap money could turn fear into speculation and weakness into rising asset prices. Capital moved further out on the risk curve. Stocks rose. Real estate values climbed. Private markets expanded. Leverage became easier to justify. But inflation changes the rules. Once inflation remains above the Fed's target, central bank credibility becomes more important than market comfort. To understand why Warsh's debut mattered, do not start with the stock market. Start with the front end of the Treasury curve. The two-year Treasury yield is one of the cleanest market signals for where traders believe Federal Reserve policy is heading. After Warsh spoke, traders dumped short-term Treasuries. In bond markets, that means prices fall and yields rise. That inverse relationship is one of the first laws of fixed income. When bond prices go down, yields go up. The deeper signal came from the shape of the curve. 30-year Treasury yields slipped to their lowest level since late April, while the premium over 2-year notes touched a 14-month low. In plain English, the market was saying, tighter policy now, stronger inflation credibility later. The real shock was not only what Warsh said, it was what he refused to provide: forward guidance. For years, forward guidance helped investors believe they knew where policy was going. It reduced uncertainty, compressed volatility, and encouraged risk-taking. Warsh shortened the Fed's statement, declined to give a personal view on the future path of rates, and avoided boxing himself into a predetermined policy path. To professional investors, the implication was unmistakable. The market would have to form its own view, and volatility was the price of that independence. When asked why the Fed had not already raised rates, Warsh largely sidestepped the question and described the internal debate as a good family fight. That phrase mattered. It told investors that policy was not on autopilot. The next move was live. The Fed's own projections reinforced the signal. Half of individual Fed officials expected rates to rise by the end of the year. The problem for investors was that the economy was not weakening enough to make the Fed comfortable. Job growth had picked up, and the economy remained surprisingly resilient despite repeated warnings that a recession was near. A record-setting stock rally had supported consumer spending, helping offset some of the pressure from higher prices. At the same time, the artificial intelligence boom unleashed a wave of investment spending from the world's largest technology companies. That combination, sticky inflation, strong employment, rising asset prices, and AI-driven capital spending, created a serious risk for the Fed. If inflation did not cool, it could mean monetary policy was still too accommodative. That was the warning from Rob Kaplan, vice chairman at Goldman Sachs and former president of the Dallas Fed. Kaplan said that if inflation prints did not cool by September, the wiser move could be to take action in September or later in the fall. He also warned that Fed moves are rarely one and done. If the Fed hikes once, investors may need to prepare for 2 or 3 moves. Before the latest meeting, traders expected the next hike around March 2027. After Warsh spoke, markets priced a quarter-point hike by October this year. That was not a routine adjustment. It was a violent repricing of the future cost of money. The U.S. interest rate is not just a domestic policy tool, it is the anchor of global asset pricing. When the interest rate, which is the discount rate for asset valuation, rises, the present value of future earnings falls. That is why growth stocks and long-duration assets are so sensitive to Fed policy. Real estate feels the pressure through financing costs and capitalization rates. Stable rent does not protect valuations when the cost of capital rises. Private equity feels it through leverage. When debt becomes more expensive, Yesterday's deal math can suddenly stop working. Emerging markets feel it through the US dollar. Higher US yields can attract capital away from riskier markets and make US dollar debt harder to service. That is why a faster-than-expected US rate hike can pressure both stocks and bonds around the world. There was another layer beneath the market reaction: central bank independence. Warsh took over after intense political pressure on the Fed, and markets wanted to know whether he would defend the inflation mandate or bend toward easier money. One investor described the challenge as appeasing two masters, reassuring markets that Fed credibility would not be sacrificed while avoiding a direct political confrontation. The market's conclusion was clear. Warsh had renewed confidence in the Fed's inflation-fighting conviction. The lesson from Kevin Warsh's first test is not simply that interest rates may rise. The deeper lesson is that Warsh removed certainty. And in modern finance, certainty is one of the most valuable assets of all. When the price of money changes, everything reprices: stocks, bonds, real estate, private equity, currencies, and all other global assets. If you want to understand the hidden financial and business machinery shaping markets, companies, and economies around the world, subscribe to the Global Ledger. And tell us in the comments, is Kevin Warsh restoring Fed credibility? And is the market underestimating the damage higher rates could do? Until next time, follow the intelligence.